If you're a Canadian homeowner, I got a few quick questions for you. Would you like to pay off your mortgage faster? Would you like to reduce your tax bill? And would you like to invest more for your future? I'm Robinson Smith. I'm president of Smith Consulting Group Limited. And if you're interested in answering these questions, you can join me and Jennifer Hunt of Real Estate Wealth Lab on June 8th for a free event. We'll be discussing these topics. I think you'll find it enlightening. Hope to see you there.
Wow, I absolutely love that video. Good evening, everybody. Richard Dolan here, Chief Growth Officer, sitting here on behalf of the Real Estate Wealth Lab team. So grateful that you've spent the time tonight to reserve it for us. I know I'll be introducing you to a whole bunch of people in a moment, but I definitely got to do a quick shout out to Jennifer Hunt to say hello, our Chief Intelligence Officer, and all cool things that come with Rule. But what a delight. I mean, just amazing to be on the road. I'm currently stateside building up a real estate portfolio south of the border. If you're in Canada, that means yours. If you're in America, that means yours. But here I am, happy to be here, grateful that we're all together. And it goes without saying that I'm delighted that you're joining us tonight. I'm going to get straight into the program because it's important for you all to know that we've got an agenda and we've got a plan. And we're here because it's a research lab event. And we're going to talk about inflation. That's the cost of living. And if you haven't noticed, it's not going down. We're going to talk about stocks and why and how this affects and how it impacts real estate. Believe it or not, when you've got these seismic economic shifts going on, they're the tectonic plates that are underneath this earth we call the ground. When they move, everything moves around. And as Jennifer is going to point out, and I don't want to steal her thunder, but I have to say that the rules about real estate investing are about to change again. And I'm happy to hear that she's going to be doing that tonight. So I'm delighted to be here with you. And I got to just say, did you notice in the video, I love that a number of things came up in the video. We are here to talk about what's new, what's now, what's next. And oftentimes, if you've gotten to know me over the years, I'm a real fan of understanding what's new and what's now. But I'm also keen to know what's next. You all get that? I mean, what's next is really what's important. What's next allows you to be either a holder, a buyer, or an accumulator of real estate or any asset class that's worth it. Understanding what's next is being able to not just predict the future, but understand what comes next after what is currently now. And in real estate, like anything, the only way you actually stay wealthy and own great properties, assets, or anything of value is to know what the future valuation on that very thing you own is going to predictably be and have it be intelligently so proven for you. And so for us here, and I know what's really important for all you to get is this is not, and I repeat, this is not something you get to. This is not something we're going to do to you. This is something we do together. I'm going to tell you that the Real Estate Wealth Lab welcomes you because this is your conversation about real estate, not mine, not Jennifer's, not Paige, not Naran. I mean, not Vincent, not Steve. It's yours. And I think that for those who are very successful in real estate, and I've been in real estate now for just over 15 years, I'm actually quite new to it, but I've got to tell you, real estate is a collaborative community of achievers. There's no other asset class in the world where you get to, in fact, make money and do well doing it on your own. In this particular world, real estate is a team event. And sometimes we don't realize that we've got to count on one another, and not just realtors and mortgage lenders, not just appraisers and all the other wonderful people that come in and out of your property to make sure they improve it, make it better, have it be efficient, have it be marketable, increase its value. But you need tenants and you need lawyers, right? You need fellow investors to be inspired by and wanting to aspire for being like them, building like them. So this community, the Real Estate Wealth Lab, welcomes you to your conversation about what's new, what's now, and what's next. And talking about what's next, let's talk about what's up tonight. So from 7 till about 7:30, we're going to start talking a bit about what Rule is now looking like. Rule has been and remains to be a very fluid business. And the reason why is because it's not in business to be busy, it's in business to keep you on the right and narrow. It's fluid. It's consistently and constantly reevaluating how we can impact you, help you to be a better, stronger, faster real estate investor. And we're listening to you. And that's why Rule is, in fact, a very fluid community and offering. From 7:30 to 8:30, we're going to talk about the next level real estate intelligence, a conversation about both Canada and the US. At about 8:30, we'll then move into, for the next 20 minutes, the market analysis recap. And then by about 8:50 or so, there'll be some closing comments and conclusions. And I know the entire team's delighted to walk you through it. So for those who don't know, and for those who are here and are new, I got to admit something to you. For often we hear this term rule. It's not as in rule as in the way it's done, the regulatory means, and or the manner in which something must be followed. Rule is an acronym. It's for the Real Estate Wealth Lab. It might as well be called the Real Estate Wealth Leadership or place for lessons or learning. I mean, rule is really new because it's you. It's new because it's you. It's a response to a marketplace where folks like Jennifer, folks like myself and Naran and Vincent and Ken Klinoftakis and Rob Iacchetta are real investors in real time, sharing what it is that works for them and what doesn't. So that's why it's the Real Estate Wealth Lab, not the Real Estate Wealth Institution. Real estate's fluid, and therefore the lab allows us to move and roll with the punches. Whether they're moving dynamics or economic changes, real estate investing is not a static event. We know this as real estate investors, and that's why it's a lab, not a university, not an academy, and it's not stagnant. This is a laboratory that's comprised of specialists focusing on real estate coaching and opportunity and research and education. And you want to know why? Because it's real estate investors like you helping one another to achieve the next level, whatever that means for you. So there's three interesting dynamics that have come together to form what rule is. It takes some predictive intelligence, a little bit of let's lean in on the research, analysis, and the data and figure out what's going to come next before it happens. There's these leaders, folks I've just cited, but accomplished real estate investors today. These aren't buy and hold folks. These are buy, build, renovate, fix, flip, cash flow, yield, and on and on. We are all active investors. So we're not just talking about what you should do. Rule is about sharing what we are doing. We're not preachers, we're leaders. We're not here to teach, we're here to inspire. So that by way of coming together, we get to understand that real estate investing is a team event started by and always driven by great people like these. From Jennifer Hunt being the Chief Intelligence Officer, myself as a Chief Growth Officer, from Naran Kalathungam, the Chief Leadership Officer, Ken Klinoftakis. Hard to believe that that's him because he looks far more handsome in the picture than he does in person. I'm just saying, I'm just being honest here. Okay, maybe not. Chief Operating Officer, or Vincent Sundar, Chief Technology Officer, or Jan Katarovsky, the Chief Marketing Officer, and Rob Iacchetta, the man in charge of real estate strategies, and Paige, Head of Customer Experience. Here's what they all share in common. They're all good looking. No, I'm kidding. No, they are. But what I'm trying to say is they're all in real estate. This is not something that all these folks are just pretending to do, wanting to do, or are inspired to do. Rule is built by a group of people who are in real estate because it matters to them in one way, shape, or form. And for that, I applaud them. So for anybody that's really looking at Rule for the very first time, I got to admit to you, I have a membership at a lot of different things. I even think about myself at Netflix. I got Netflix, I've got Amazon, I've got Disney, I've got Crave. And you want to know something? I don't need to watch one channel. I like watching all of them because selection increases the probability of elevation. I want a variety. I want to have a real wonderful spectrum of options. And so when it comes to rule is not something that you have to choose over another or you have to choose instead of. It's another complement to you, no matter what stage of investing you're at. Whether you're a beginner and you need to know where to start, what process to endure and or to proceed with, whether you're experienced. And I got to tell you, I'm experienced. But I get stuck. And you know what stuck is, professionally speaking? Complacency. Complacency is another form of stuck. And right now, if you're writing down in your notes, I got to tell you something. You want to know what you want to be addicted to, especially when it comes to creating for yourself more financial success, is more. More is always better than not enough. You'll always want more. If you got one door, get two. If you got two, get 20. If you got 20, get to 100. Why? Because more is better than enough. Then, of course, there's the next level. real estate investors. And I think this is where particularly Rule really rocks. Rule rocks here because they understand that exiting, having an equitable event, succession planning, or just simply understanding how to mitigate taxation and or minimize the capital cost of exiting a portfolio, whether it's one door or many. The idea is that Rule was built by real estate investors at the various stages and states of life. So for us, what we know is that the problem you've got or the challenge you have, Rule is for you. No matter where you are or what you're up against, whatever you want that's new, next, or now, Rule has got it. And so what we know from this experience is that, number one, what Rule does best is it understands the research from an investor's perspective. Now, again, another admission, as a real estate investor, do you want to know how I grew my portfolio? Do you want to know? I've never really admitted this outwardly, but I wanted to make sure I took the opportunity to tell you, because I'm not that sharp, but I'm super driven. So what I do is I leverage smart people. In fact, Ken Kalinaftakis, the chief operating officer, I bounce ideas off him all the time to have him do the assessment and for him to do the due diligence. Do you know what I call that? I call that smart. I call that smart. Warren Buffett once said that the best way to make money is by using other people's money. Well, Steve Jobs also said that the best way to get smart is by leveraging smarter ones. And I'm using folks like that. Rule has been able to assemble lots of great minds to say, why don't we help people understand market analysis? I would write that down. The Achilles heel to any real estate investor, whether you're just getting started, well on your way, or you want to get to the next level, is performing the analysis. And you don't want to know why we don't do it? For three great reasons. One, we don't know how. We don't know how. Number two is we don't have time. We don't have time. But number three, and most important, I do mean most important, is we're not willing to learn how to perform the analysis. And by the way, the bonus fourth is even if you do the analysis, you don't know what to do as a result of having it. Don't believe me? Look at how much times you've looked at the analysis straight in its eyes and said, now what? Now what? So what I love about Rule is that they do the analysis. What I love about Rule is able to help people get the quick facts, looking at GDP and jobs, looking at population trends and rents. It looks at listings and its trends, home prices, where they're going. And what they do is they help you make a decision. Because real estate investing is about doing, not being told what to do. And I think that's really important. I think one of the other cool things about Rule that I really appreciate, being as busy as I am and quite distracted by other life's stuff, is that they summarize the news headlines. And I don't mean summarize as in, let's shave down your reading time, but they actually, in fact, take the time to tell you what the news and the headlines mean. So when it comes to understanding it, you're not just talking about the repetitive regurgitation of what you need to know or what you need to read. What they're doing is they're saying, given your real estate investment interests, here's what it means to you. Here's what you must do. Here's what we hope you heard. And here's what you should keep an eye on. Does that make sense? Just give me a thumbs up. Fantastic. And I like that. I like it because what it allows me to do is it allows me to get started, refreshed, restarted, or up to the next level. That's why what's really cool about Rule, if you've not noticed this in its rebrand and relaunch, is that they've got a stellar quick start program called the Starter's Guide, where it has modular-based learning with worksheets and all to help walk you through how to get started or restarted in real estate investing. This is particularly good for anyone that's raising money with people who don't know how to start in real estate. Great for people who have already started but have lost touch with their starting points, and or people who wish to inspire others to co-venture with them. What a great tool to have to hand along. So you don't have to be an expert in teaching people about real estate. You just be the expert in real estate and let others learn through our tools how to do the same. Most important, I think, one of the key things I love about Rule is the fact that you want to know step by step what there is to do. But one of the greatest challenges that we have in real estate is the amount of time, effort, and energy we underestimate it takes to get into real estate, to execute a deal, or to in fact pull the trigger. That's why, built by real estate investors, Rule is the only company on the planet that has the property technology, also known as prop tech, actual calculators built by real estate investors who do the math. So if you're tired of Excel spreadsheets, I can't stand them. but I know people who love them. Yes, I'm not talking about you, Jennifer, because I know you like your Excel spreadsheets, maybe. But Ken Klinoftakis, my God, I don't know if you know Ken Klinoftakis well, but he has a room in his home that's actually wallpapered from floor to ceiling in Excel spreadsheets. Don't know how that looks, don't know how the family feels about it. But what I like about what we've done is they built calculators that are easy to use. They're intuitive. So what they do is they allow you to crunch numbers and actually understand deals within a matter of minutes. Rule makes life easier. Rule makes life easier because it does a lot of the heavy lifting for you. We also want to make sure that we have you avoid using confusing spreadsheets. So with this fast and friendly number crunching calculators with all kinds of very cool guiding pathways on what to do with the math, you've got to really appreciate that whether you're calculating monthly income or property forecasts, this is a wonderful tool set to have. If you've raised money already and are needing to communicate with your clients, your investors, your joint venture partners, what deals are doing and how they're doing. It might also be, in fact, a great way to raise funds from people, to attract co-venture partnerships, or perhaps to renegotiate new deals ahead of you. These calculators are your friends. They are your tools, and they are, in fact, a great force in the world of helping you forge a greater portfolio. What's also neat about Rule is that they have what's called the property shop. And this is where you get to really utilize a community, whether you're looking for a pocket listing or wish to share with others your listing. But here's the reality, and not to knock listing, but we all know that as owners of real estate, we don't want to list our properties that are already tenanted to put it in the marketplace. This could impact the way in which your tenants see the future of where their home shall be. The last thing you want to do is market a property that's vacant. So what a safe and wonderful way to be testing the waters. And in these times of an interesting deflammatory sense of where there's a depression in pricing due to inflation and the cost of borrowing, and I'll leave all the analysis and technicalities to Jennifer, the reality is that you just want to test the market. The property shop is where you do it. This is where you find or list unique off-market deals in the property shop. It's a property shop for members, by members, and their properties. And it's a great way to scale your portfolio if you want to, in fact, get access to real estate investment advisory courseware. In other words, if you're out there and you've got friends and family, cousins and or uncles said, well, hold on a second there, Jimmy. What do you know about real estate and why are you asking me for money to invest in real estate? You get to say, well, you know what? I'm actually qualified to have a conversation with you about why real estate is a great asset class for you to own. And I would love to invite you to the opportunity of co-venturing with me into this property or that up and down or this particular multi-unit. You see, the reality is that most of our friends and family don't identify us as professionals in real estate. And just because you own a property doesn't mean you're a professional, not in their eyes. But at the Real Estate Wealth Lab, there is advisor courseware that allows you to give yourself the appointment and the vector, if I may, the title, if it were, on being what we call an REIA, a real estate investment advisor. So as you talk to people and share with them the opportunity of investing in real estate, you get to do so with a little bit of professional gravitas, a little bit of academic structure, and a very deep appreciation for earning the kind of professional credibility and profile you need when raising money. And here's the neat part about our community. With all those I've mentioned earlier on, and I'll cite yet again, we all don't have just fancy titles. We've got some great strengths, skill sets. Many of us, in fact, are epic and legendary in our own right for doing great stuff that this marketplace of ours called the real estate investor industry has really counted on us for. From Jennifer and her research, from Naran in multifamily, Ken and how to operate logistically a great portfolio. You've got Rob, who understands finance and strategy, Yan, who understands marketing, Vincent, who understands property technology and how to leverage it to be your friend. Even Paige is an expert in client and partner experiences, and myself, raising capital. So any of those topics of importance to you, you can always count on your stable of leadership to really lean in and learn more from us to understand how you too can tap into our brain trust. But here's how it comes down to the opportunity. Starting at $9, that's right, $9, the cup of coffee from Starbucks is about that price, especially if you have it super fancy like Naran likes it, super frothy with a dash of this and a dash of that. But $9 a month, you can access many of our beginner add-ons from $9 a month. Our beginners package starts at $19 and it goes up from there. Here's the reality though. When you get started with membership levels that meet your budget, you don't get caught up in what it costs you. You start investing in what it'll give you. Because when you take money as the cost of entry, as the barrier to having more, well, now all of a sudden you get to focus on more. And I think that's what I love about what Rule has done. What Rule's done is they've been able to, in fact, say, hey, why don't you just start with a $9 a month membership rate? There's no contract. You can cancel anytime. And you get to access at least the basics for how to stay connected and carry your momentum. And I want you to write that word down, momentum. Momentum is your friend in real estate investing. The moment it no longer is, you could be in trouble. It's where you get stuck. It's where you slip and you miss opportunities. But for $9 a month, you get to, in fact, access the articles and expert commentary, the city-specific market analysis that includes the buy and the sell and the hold signals, the what to do for $9 a month. I mean, you can't even find an assistant for $9 an hour, let alone $9 a month. You've got a real estate investment assistant here, if I may say, that's accessible 24 hours a day, 7 days a week. You get to access all the video presentation library with a wealth of video slides, notes, and all the other important tools that we manufacture just for our community members. And you get to access the deals in the Real Estate Wealth Lab property shop. Super great. Now, for beginners or those who want to get started on your very own, or even begin to understand and embrace coaching as a way to hold yourself accountable to growing your portfolio, raising money, connecting with others, or really dominating your investment and wealth goals, you can start with the beginner package at $19 a month, which will then include everything the $9 membership includes, but also comes with the rule book, quick calculators, access to the deals inside the property shop. But you can also go with the beginner with coaching, which is only $49 a month. And this is where you get the rule book deep dive. These are live weekly group coaching that puts the theory you learn into action. And I've got to admit, at $49 a month, this is better than you being left to your own devices to doing it on your own. But enough about me and what I mean around this. I got to tell you, for me, it's all about the expert experience. Because if you don't set your goals high, you will always perform low. This is the phenomenon of human performance. If you don't set your goals high, you will always perform low. It happens in fitness, it happens in nutrition, it happens with saving money, it happens in real estate investment performance. When you don't set your goals high, you can count on performing low. So what I would do is I would say, hey, at $99 a month, I'm going to play and perform like a pro. If I'm going to play and perform like a pro, that means I'm setting myself up to learn like a pro. I'm going to start looking at the world like a pro. I'm going to start investing like a pro, owning like a pro, having a portfolio like a pro. You want to know why? Because when you set your goals high, you never then again perform low. And so that's the whole idea. You want to make sure that you get to set yourself up to get all the things I've said and then some. The cool part about this, though, is that you get to use the prop tech in Rule to really perform your portfolio prognosis and perform all the calculations you will ever need. Now, if you don't believe me, we're going to do something that's super special. If you scan the screen right now, that little VR code, and for those who are challenged because your Blackberries don't work with camera, I know that never gets old. I'm so sorry, Jennifer, that never gets old. But if you don't have a camera on your device, you can actually type in www.yourrule.com/trial. And it will allow you to enter a draw where not only will you be able to get a 14-day trial with everything I just told you, no obligation, no cost, you're automatically entered into a draw to win a free year subscription worth $1,200. That's a pretty cool opportunity. And I just got to tell you, you'll want to do that. If you can't try, you'll never know. And if you never know, you'll never grow. I mean, if you never know, you'll never grow. So you got to ask yourself this question: what am I doing today that I've not done yesterday so I can get something more than I've had before? This is what it all comes down to. So you want to take advantage. Get your phone out right now. Come on, get your phone out right now and scan the QR code, download the 14-day trial, and then become automatically entered into the draw to win an absolute free year-long subscription of the best stuff that Rule has got to offer. That's a $1,200 That's a $1,200 payoff doing just that, taking a picture. Not too shabby. All right. Well, that all being said, I want to make sure I move along because I promised that I wouldn't take long, and I think we're right on schedule. So, hey, thanks for listening to what I had to think about, say about, and share about the research, the insight, the education, the analysis, and the leadership, what we call keeping it real at Rule. Because keeping it real at Rule is what Rule is all really about. I'm going to come out of my screen share here because I'm going to come on over to Jennifer, because I know, Jennifer, you're super excited about what it is that you do and how you've been doing it. And I got to just say, I'm super excited and so thrilled for you because you have entered a whole new realm of real estate investor leadership. I mean, there's people who talk about you. There are people who are now applauding you. There are people who simply thank you for becoming the real estate investors they are or are remaining thanks to your leadership. So congratulations to you. Grateful for the great work that you're doing. So without much further ado, let me pass it over to Jennifer Hunt.
Oh, well, thank you so much, Richard, and really appreciate you sharing all of this amazing new stuff. Look at us, guys. Oh my gosh. And this is all in response to you and to the members out there and to the members who are about to be out there. So we're looking forward to you joining and coming along our journey with the Real Estate Wealth Lab. So again, big hand for Richard Dolan, our Chief Growth Officer. And what that means is he's there for you. He's there to help you as a member grow your portfolio. So that's very exciting. So thanks so much, Richard. And you know what, I just want to take a moment and acknowledge everyone. It's so great to see you, Mark and Nick and Steven. Very cool. Very, very cool. Yeah, Hugh and Cynthia, I see that you're on, which is awesome. And Nima, hello, girls, good to see you. So we are going to get started, I think. So I'm going to get, yeah, it's okay if I start a couple minutes early. Let's get on this, right? Yes, it's a big night. Dawn, what were you eating? Looked like a good dinner. Oh, all right. That's great. Okay. I'm going to share my screen. So one moment, please. Actually, just a second here. There we go. Okay. You see my screen? Yes. Perfect. Awesome. Okay. Well, let's get this going. So today is very exciting because, well, there's always so much going on, as you know. What we are doing tonight, though, a little bit different, is we're doing a market analysis summary because some of you have just joining us, which is awesome. I'm so delighted to have you here. And for those of you who may have joined us various places, you know, whether you started with us in January or you've been with us since we even did our pre-launch back in September, you're going to want to check out just how much market analysis we've done, and we're just getting started. So we've got a little special treat for you a little later on today. We always have our disclaimer. Essentially, our disclaimer here is all the legal mumbo jumbo. That's really important, that if we are looking at forward-looking information, et cetera, you need to do your own diligence, of course. And or if there's any other predictions or forecasts, you got to check those out against your own methodologies as well. But we're going to get you well on your way. So in the chat rules, please ask questions. This is interactive. Say hi, engage, share your feedback. It's your thoughts, your ideas, what you want from the future, what you want right now, whatever it is, as long as we're being respectful, courteous, and kind. And please don't solicit. That's the only it. Don't solicit, don't sell. That's not the time for it right now. So those are the only chat rules. And just a little housekeeping, this is being recorded. So be known that it is being recorded. So your dinner, Dawn, is on. Kidding. And that's awesome. And we want to see as many of your beautiful faces as possible, always. And so Richard's already gone through our agenda, so I won't spend any more time on that. But I do want you to take notes on that. Actually, I'm going to go back to this. I may be a little bit longer than this extra half an hour on the real estate news intelligence, the macroeconomics, because there's a few things going on, but I will try to keep it fast. And you're going to notice that something that I do is I'm actually including more slides with data that I may just kind of go over quickly because it doesn't apply to everybody. But if you want, the reason I'm including it is because all this is available to you. The recording's available to you, and it's actually done in timestamps, so you can go back right to a section. So it's super efficient for you. I love efficiencies. And what else is that you can go to the actual PowerPoint deck, and that will be available to you. So you can pull the data and put it into your own slides. You can share it and look like a superhero in any way, shape, or form that you'd like. And so as a result of that, there are going to be moments where it's going to be like, oh, okay, there's lots of data in here. And I might go over it, but you know who you are if you want it. So it'll be perfect for you. And yes, that will be available who aren't, oh, for those of you who aren't currently members. Paige, maybe you can answer that. I'm not sure. Thank you for asking. Okay. So what I'd love for you to take note of is this is another one of those QR codes where you take the phone and hang it out there, right up there on the screen. And it's going to automatically register you for the next event. And the next events are down below on this screen. And June 8th is actually a Market Leaders Lab event that we have with Robinson Smith. Who knows who that is? Robinson Smith is his father actually is the founder of the Smith Manoeuvre. It's a very, very cool, advanced opportunity to accelerate your portfolio. Highly recommend you getting out and coming out to that one. So then June 15th, we have a community lab and then research lab on June 22nd. And then we do this. So this is on the 2nd, the 3rd, and the 4th Wednesday of every month. We're hanging out here. And yes, there are also live events coming up soon. But for now, we've got our Zoom lines to hang out with us on Wednesdays. So I'm going to get right into it. Research lab. Here we go. So a real estate cycle. What the heck is this? You've heard of it. You know, lots of it. No, what it is it's simply the business cycle of real estate. That's it. It's just like any other business cycle, where you have contractions, where you have an expansion, where you have stabilization periods. And we need to know what these are and also the duration. And that's been traditionally one of the most challenging things to predict and forecast is indeed that actual duration of the real estate cycle. Well, not for us at the Real Estate Wealth Lab. We have a proprietary real estate cycle formula, and we're actually able to predict with great accuracy, I'd say forecast, that duration. You can see it changes and it moves depending on what leading economic indicators, what other factors are going on, what politics and policies are happening. And that's what we look at all of the time, and we're constantly refining it. So this is what the real estate cycle formula looks like. It's not stagnant. So what we see is that we've got certain indicators, these leading indicators. For example, people is a major one, jobs and GDP, but they have a different weight, very much a different weight, so that at different times they have different levers and they're having a different impact. And we need to understand exactly what that is and how they play with each other. Then those end up impacting our lagging indicators, which are our rental market stats, as well as our property market statistics. And actually, although a typical kind of cycle could be around like a 1.5 to 2 years, it actually can go upwards of 7 and 10 years. And I've been able to actually forecast markets as short of a 6-month cycle using this exact formula. And you have access to it every week. You get updates with our real estate intelligence newsletter, and every month with our market analysis. Cool or cool? I see some smiles and some, okay, this is good. Okay, good. All right, so who cares and why listen to me? Well, why do we question the media? Let's start with that. And that's really about the newsletter. We want to look at headlines, but we need to look a little deeper. And why I care so much is not only am I a real estate investor. Let's start there. So I have a portfolio in both Canada and the US. I've had everything from vacation rentals to student rentals to apartment buildings. I've done industrial development, you name it, commercial leases for the Olympics, some weird, wonderful, wacky, wild real estate deals, and I love it. Now, add that, and I have a master's degree in communications, and my thesis happened to be about news and sensationalism and how it impacts democracy. But most importantly is that I love research. And this is from my professor who says, please continue to perform research because you're really, really good at it. And this was just after my draft of my thesis. I'm not saying this to brag. I'm saying this to share with you that I really, really care. And I'm really interested in doing this for you. And so I'm grateful for all of you for being members, for supporting the Real Estate Wealth Lab so that I can share this with you and continue to do so because you want this, even if you don't know that you want it. You want to know why? Because of this. Fake news. Anybody heard that term? Yeah. Well, I was on to fake news back in 2005 before it was fake news. So again, ahead of the curve. So what you need to know is that rules got you. And I'm not suggesting that anyone here is in denial, but certainly elsewhere in the world, there's a lot of denial. And we want to go through and make sure that we're catching you so that you don't get caught up where other people might. And that's pretty powerful. So before I get into today's larger presentation, I want to share that we've been in the news. So wait. You're Jennifer. You just said that the news is incredible. Exactly why we want to be in it and share the exact true story. So it was very cool. A couple of these are some awesome reporters out there. And I just want to say a huge thank you to those of you who have been covering us. We're very grateful. And I love the conversations. We're having really, really moving the needle conversations with reporters and sharing with them what's really going on. And this is one, thank you, Glenn from Business in Vancouver. So the Vancouver real estate downturn has already started. And in this particular article, you definitely want to check it out. It's not just about BC, by the way. This is about, or Vancouver even, you can really start to see some of the philosophies that are coming, bubbling to the surface. So BC is at less of a risk of recession than most other provinces. Did you know this? Anyone? All right, well now you do. So this is good. And as a result, well now you do, Charlene, so thank you. BC is actually very much buffered and I'll share with you why. And as a result, its real estate is also going to be buffered. So here's just one little snippet from this less than 1,000-word page article of what rule is contributing out there. And essentially what we're seeing with British Columbia is, yes, there's recession. I'll talk about that in a moment, but it will be milder and perhaps most likely shorter than elsewhere in Canada. And one of the main reasons for that is the crazy amount of immigration and net migration that's moving into British Columbia. And as a result, BC real estate as a whole is going to stay strong and it will be on a long, modest expansionary period for at least a decade. So thank you again, Business in Vancouver. Rentals.ca. We were one of the 22 experts across Canada that were cited and fairly extensively within the Rentals.ca 4th annual rental market predictions. What did Rule have to say? What did we have to say? Supply-demand gap is tremendous, and it is. Supply is at devastating lows, demand is at record highs, and inflation is running higher with few viable options to control it. Quote Jennifer Hunt. So what do we need? We need practical solutions to build fast, keep operations costs down. So for those of you who joined us for Tenant Cube a little while ago, that's a way to help keep operation costs down. Balance out that supply and demand for homes in Canada. And until then, yes, we're planning for a long expansionary period, replete with continuous rent increases. Rent increases are going to be on the rise with a couple of nuances that I'm going to get into when we get into the rent section. Another one, yeah, we've been in the news a lot lately, folks, and this isn't even all of them. In other words, the Canada and starting in the US, actually very much soon, a couple of podcasts in the US that are reaching out are really looking for experts who are not taking the, I'm going to say a swear word, who are just taking a leadership role out there in the world and aren't following all of the headlines. How's that? So Canadian rent prices set to keep climbing as supply falls short. So there's really no relief in sight for rising rent prices across major Canadian markets as the country's population continues to outpace available rental inventory. And again, what we're seeing is that gap between the supply and the demand, it's major. It's absolutely major. And so we are showing that that gap is tremendous. And again, as long as Canada's immigration targets, among other indicators, which are lots, we look at many of them, upwards of 23 or 24, just in the real estate cycle formula. And we don't have any reason to think that this would change. So new arrivals are going to be placing even more pressure on rental housing demand and pushing rents even higher. Whew. So that's just in the last 3 weeks. All right, and we're just getting started. So let's get into GDP. So I'm going to go through. Here's what you need to know about GDP. Here's just a quick one from Scotiabank forecast tables. This is what we're showing right now. This is just as of this week. Oh, anyway, this month for sure. I can't remember what date did I put it on here. Doesn't matter. Anyway, this is the most recent. All right, real GDP. Stabilizing growth is sustainable growth. This is good news. So as you can see, Canada in 2020 and the US down. 2021, not quite making up that difference between 2020 and 2021 in Canada. In the United States, it has made up the difference. This is what we call net GDP. Way to go, the US. Way out. That's awesome. Canada has a little ways to go, but we are, for 2022, having that sustainable growth. We'll have definitely gotten out of the recession from 2020 for sure this year. And what you'll see is it'll go down because it's percentage increase over the previous year. And that's exactly what we want. You do not want to have 6%, 7% GDP for a long time because A, it's either fake, or B, it's not going to last. So these are great. Allie, there are a large number of purpose-built rental developments in Alberta and Toronto. Do you think that will put downward pressure on rents in those places? Those are great. That's a great question, Allie. Especially in Toronto, unlikely. There is such a gap. What I'm saying with Toronto is there's such a gap in supply and demand everywhere across Canada. But in Toronto, especially when it comes to immigration, it's one of the main hubs where immigrants land. So it's really unlikely to make a dent. And similarly in Alberta, depends on the location, of course. I suspect you're probably talking about Edmonton and Calgary. There's still plenty of room. And also in Calgary in particular, they did have excess condominium supply for the last couple of years, and it's been absorbed. So there's still now room for that opportunity there. Hope that helps. Awesome. Thanks for the question, Allie. So gross domestic product in the US. Wait a second, what's going on? So the Bureau of Economic Analysis is saying that the US GDP is down 1.4% annualized from Q4. So Q1 is down from Q4. This isn't good news, but it's based on incomplete data, and tomorrow is the next release with the complete data. So again, you see these headlines? Are you going to get into that? No, we don't want to spend a ton of time here. We want to be aware of it. This is why I'm showing you this. Don't get stuck into it. And also, what they're showing is that, okay, yeah, it could be a deteriorating economy. Yeah, for sure. We've got some things to talk about, and we have been. But there's still like a huge amount of demand hitting against those production constraints. So what is driving that? And it's not a clear picture at the moment. It's nothing to be nervous about. And we've got a couple of slides about that in just a moment. I hope that will help round this out. So Hedenbridge, news, expert warns that U.S. economy is on shaky ground. Yes, okay, see, so we're starting to see like these kind of recessionary talks. And indeed, there is that option, and it is quite likely. This is what I want to share about this, though. It's quote unquote, it's a common behavior of everyone to look at just the stats shown in headlines and never to get down in it. And that is my job for you, ladies and gentlemen, is to get down in it. We dig. So if you dig, you will know that the unemployment, this is interesting because I actually disagree with this. So watch it. Even when you dig, what are you digging for? So if you dig, you will know that the unemployment rate is declining just because of the falling labor participation, which means that fewer people entering the labor workforce. Maybe not. So for those of you who joined us in January, at our research lab, you will absolutely know that this whole participation rate situation has to be debunked, and it has, and we've looked at it very, 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 very much in depth. So what you do need to know about this is, in addition to that, by the way, and I will get into that a little bit more deeply about the participation rate, so just hang on. In addition, it was unnecessary to pass the $2 trillion of COVID bailout bill because it merely continued to pump up the demand into the system. And it was obvious that inflation would spike from this step as a big gap had emerged between the demand and the supply. All right, now we're getting into some digging into some depth here, printing the money, which causes some challenges, and that causes inflation. So we'll talk more about inflation. You can see that at every moment, there's something that has to be unpacked even further. And that's exactly what we do at Rule here, but also on our weekly basis. So here's what I want to say. Please don't freak out. Don't freak out. Stay tuned. There are dozens of indicators that show long-term, modest expansionary period for real estate, even in the face of an economic recession. Is that clear? Give me a yes if that's clear. Yeah, thumbs up. Okay, awesome. Thank you. So what it means, the headlines don't capture what we need to know. Bear markets. Bear markets are where it starts to like hibernate, slow down. We are entering in some softness in the economy, not right away, but it's going to feel that way. And the reason for that is inflation, which I'll talk about a little bit more. So because inflation is here and it's here for a long time, bear markets, by the way, it's happening, but they don't last forever. So what we also need to know is that inflation is a real estate buy signal. So these are buy signals. So stick with Rule is our ongoing analysis for the latest, the deepest, and the most meaningful interpretation for real estate investors. For those of you who are Elon Musk fans, but for those of you who aren't, whatever it is, this is what he has to say about it. He's fairly wealthy. He also agrees that there is a recession that will last about 18 months. Recession time is impending. It has to be in order to combat inflation. And so for those of you who are just joining us for the first time, you'll want to definitely get back into some of our archived presentations that dive into inflation so that you can understand that. But without spending a lot of time on it, inflation requires interest rates to increase, printing of government money to stop, and unfortunately some unemployment and recession. That's just how inflation ends. So given that we've got major inflation, we can expect it. So we are expecting some form of recession. However, again, while that may be the truth, and we've been forecasting this since our pre-launch for over 8.5 months, we've had a lead on others. So even before Elon Musk was saying that there would be a recession, we were already talking about it. So who do you want to hang out with? Hopefully, yes. And how will it impact real estate? So it's and first of all, this too shall pass. It might be uncomfortable, and for sure we need to be resilient. But for real estate, I'm not talking about anything else right now, but for real estate, the economy is but one indicator. And I know that might sound counterintuitive, and that of course, if the economy goes down a little bit and softens, wouldn't real estate do the same? Not necessarily, ladies and gentlemen, because there's so many other factors at play, including supply, including demand, including a whole bunch of other indicators that until we have our copyright through, we'll let you know, but we have them in the background that we're looking at. So why a recession? Because we had a life jacket economy. All that money that was printed and put into the economy, CERBs and the SUs and the stimulus package, this, that, and the other, printing the money when the economy was not at optimal. And so as a result, what we're going to see is a deflation of our economy, not a burst. Very, very important. See how that little balloon is just going down? It's not a popping balloon, okay? So what you need to know is that inflation is here for a lot longer than people are letting on. It is a buy and hold signal, though, in real estate. And real estate happens to be one of the most stable assets during those turbulent times. And one of the best performers during inflationary times. So typically outpacing inflation. And we're both in turbulent and inflationary times, which means that it's double buy signals. Yeah, I know this is all counterintuitive. If I were Warren Buffett right now, I'd say, what do you do when people are scared? Basically the opposite. So I'm not Warren Buffett, but I'm Jennifer Hunt. And when you have inflation and you have crises, you buy or you hold at a minimum. Real estate, that is. Okay, so this is where we plot on our real estate cycle formula. This is very, very rudimentary, but in the background, we've got all the AI and cool stuff going on, but you get a sense of it. Okay, so we're kind of going up a little bit on the GDP, on our leading indicators. Not bad. It's going to start to level off, but look at all these other things that we're looking at. 23 other indicators. So jobs. More US jobs added in April than expected. Go America, go America. So employment is up 428,000. The unemployment rate is the same at 3.6%. All of this is lower than the expected gain, but it is still a gain. And this is where, again, these headlines can just make you feel deflated itself. But no, a gain is a gain. So embrace it and celebrate it. So again, that's buy, that's a hold. These are good. It's all in the right direction. And why do we care? Jobs are leading indicators that forecast rent about a year out and property prices about 2 years out, depending on other indicators, but that's a general rule of thumb. And job growth puts upward pressure on rents and property prices. So this is all very good for our rents and property prices at the moment. Oh, here's another one. Like, check this out. Like, read this headline. More Americans claiming unemployment benefits last week. Let's freak out. No, don't. We don't want to freak out. We're going to be like Elsa and whatever in Frozen. The total number of Americans collecting unemployment benefits is at a 53-year low. So do we really care that it's like, oh my God, last week, more Americans claiming unemployment? We're at a 53-year low of unemployment benefits? I think that that's pretty good sign. So this is good. Canada from BMO. The Canadian jobs cooled down, a supply side story. Okay, let's just stick with some of the details that you need to know. The jobless rate, it's at a multi-decade low, just like in the US. It's in the realm of normal. And these are signs of a much more normal conditions. Like we're in normal. Now, the headlines don't necessarily want you to think that, but then this is BMO, but also, quote, these are my little air quotes, but also one where the supply of new workers may be beginning to be the binding constraint on growth. So supply of new workers is constraining growth. You hear this a lot. And I just want to say not so fast, okay? Please, please don't fall into that narrative. There's something fishy about it. Let's just call it that. It doesn't feel quite right. And the way it doesn't feel quite right is because I looked into the data. So the labor crisis unpacked. If you want to know more about this, please check out our January 26th, I love this title, our research lab. I'll take M2 money supply for $1 trillion, Alex. So the data do not support the labor shortage crisis hypothesis. Jobs data is actually better than pre-pandemic. This is in both the US and in Canada, by the way. The number of jobs are up. The job growth is up. Labor force is up. Participation rate is up at, equal to, or above what it was pre-pandemic. Just one moment. Mark, you've got a question. I'll let you, can you unmute? I'll take it.
Okay, here we go. Yeah, so is it possible that perhaps the type of job that people are willing to go, or the sector that they're going to go in a sense as, you know, and again, it might be that's only what I can see and not necessarily statistics, but everybody in the construction industry, you know, will tell you that they're having the toughest of time to hire and retain any employees whatsoever, as it was a challenge before, but it was not as bad as it is now. Mind you, we just stopped giving incentive for people to stay home not so long ago. So maybe it's just a reestablishment of that. But as of, I think it stopped in May, where, there was still incentive for people to stay home in Canada.
Well, isn't that crazy then? So this data that I did that deep dive in and found that the participation rate in January was already at the pre-pandemic levels. So, and now if the incentives have just stopped in, what did you say, May? Recently, right? Like just now, then the participation rate theoretically should even go up even higher than it was in January. So this whole like labor shortage, I just don't see the math. I don't see the data. What you're saying about a skills mismatch is entirely possible. There's definitely the underemployment, where people are not getting as much time as they'd like, either time or the skills and things like this. At the same time, something doesn't add up. And no matter, and I understand employment data is extremely technical and very tricky to unpack. So there's lots of nuances, but we do the numbers of themselves in their current state don't support what's going on in terms of what the media is saying. So I hope that answers a little bit more. It's messy. Is that good? Did I get a thumbs up? Where are you? There, I can see you. Yeah, is that okay for now, Mark? Yeah, okay, thanks. Appreciate it. Awesome. And I apologize, I've got a little bit of a cold. No, I don't have COVID-19, but that's why I'm straining my voice. So my apologies, everyone, and thank you for your patience. Okay, so this is what I mean. This is like major sound bites that are running rampant. And I've just come up with my own darn term, because why not make my own like everyone else does? The great parrot effect. So stick with rule. We are uncovering the myths, we're exposing the truths, and we're also uncovering the real opportunities ahead. So when it comes, oh, pardon me. So there, we're going to pop on. There we are with the jobs. So they're on a steady trajectory up. People. So how many immigrants are coming to Canada? We're still targeting that over 400,000 in 2022. Big numbers, record. 57% are economic class, and then you see the other ones. This is important, the economic class, because that means they're individuals who are ready to rent. They will be ready to buy, most likely, properties in about 3 years. 77%, approximately 77% of immigrants come to Canada with money for a down payment in their pockets, and they buy 3 years later. So we will therefore see in 2025 some added demand on real estate for purchasing. Economic class also means that they're ready to work, that they've got skills. Now, whether they're construction skills, Mark, I don't know, unlikely, but certainly that will help increase our productivity. Now, this is a UN immigration report. Canada was also mentioned in here. Well, everybody was mentioned in here. And Canada is one of the countries that receives more immigrants than it has leaving. So population, when it comes to the US, though, is that the United States has been the main country of destination for international migrants since 1970. And that has not changed. So like at all, like not even close. It is still the number one place that immigrants want to move to. And so as long as the US is accepting people, they will come, which means this is positive for rents and properties. People need a place to stay. So just reiterating that. And guess what? It is now time. There is a unanimous vote that the US will be actually improving its processing time by the United States Citizenship and Immigration. So as a result of that, they're actually expecting to up by 150% by next. Yeah, exactly. Field of Dreams, Kevin Costner. You got it, Mark. That was exactly what I was trying to get at. 100%. Build it and they will come. Open up the doors and they will come. The baseball is an American sport and so is immigration. So bring it. They are open for business. They're wanting it. And we're expecting a pretty significant increase and some really cool moves over there. So where people go, who cares, right? So where people go, there's money, there's jobs, there's innovation, there's GDP, and people who need places to live. So you, as a rental housing provider, you want to be where that action is. Where are they going to? Where are they going to land? Where's that destination? And in a lot of our other detailed, like city level market analysis, we actually go, okay, this is all macro stuff we're talking about right now. So what cities are they actually going to? And that is gold. That is very valuable in Florida. And so you'll have to pay attention to get that information. And we do that on a regular basis. So a big high five. I love The Office. So cute. So population, again, is a leading indicator for rents and property values. These are buy and hold signals for sure. So again, we pop these onto our cycle formula, and we're seeing, okay, so there's some like long, this is indicating long, steady, slow, modest growth for upwards of a decade. Yes, there will be little blips and softenings here and there, but nothing crazy, even though it seems like that's a likelihood given what the headlines are talking about right now. Interest rate, we'll just go through this fairly briefly. Nothing new to talk about. Bank of Canada, they are going to be raising their rates. These are the latest, hasn't changed since April 13th, but how much and how long? This is what we need to be paying attention to. This is why you want to hang out with us here and in our intelligence newsletter, because we're keeping you posted whenever there's an announcement or when we expect it to, and then how much that impact will actually be and what it means to you. Like even the dollar value. In a recent research lab, we have the data of, okay, so if you actually, if it goes up this much, how much is that going to actually impact you on a monthly basis in terms of budgeting and things like this. So in the US, guess what? What? Let me read this. US mortgage rates fall for the second time in 11 weeks. Fall? Wait, who's been listening to the news? It's all been about going up. Why is it falling and twice in 11 weeks? Are you confused? I'm not. And neither are you, because you're in the right spot at the right time with the right people. Mortgage rates fall in the spring. This is standard operating procedure. Did you know that? They typically fall just a little bit at about this time every year. I think the banks have quotas that they got to hit, or maybe like this is when their fiscal year end is and they're trying to do whatever. I'm not exactly sure exactly why, but this is very, very typical. Here's, again, this is a slide that I'm going to just go over really quickly, as in, here's a summary. So if you're in the US, you're an American, or if you're a Canadian that you're wanting to get an American mortgage rate, this is where they stand today. You don't need to go through it all, but you know that it's there at your fingertips. But what you do need to know is, yes, okay, just to be clear, interest rates are going up, but do you know that banks do their own thing? So banks actually, so the central bank sets this overnight rate. Overnight rate is how the banks make money off of each other when they lend money to one another. But they don't follow that rate for their customers, you and me. Has nothing, they're kind of like independent in some ways. It can be. So in other words, sometimes the central bank, this was a real humdinger in 2014. It was 2014. The central banks reduced the overnight rate. Did you know what the banks did? Do you remember? They raised their mortgage rates so that they could make more profit. Yeah. So they can do whatever they want. And that's exactly what's happening now. Even though the central banks and Federal Reserves are, Bank of Canada, Federal Reserve in the US, are raising those rates, some of the banks are saying, you know what? No. We've got quotas. We've got to get mortgages happening. So we're going to actually keep them a little bit lower. So that's what's going on. This is a short time. This won't last forever. So as they say, I am a farmer, by the way. And yes, I've worked on ranches and I have hayed and I've, herded cows. So make hay while the sun shines. And that's indeed what's going on here with interest rates in the US. Don't expect it to last. So inflation, one of my favorites. All right, buckle up. So the Toronto Sun Finance is worsening for Canadians as inflation surges. All right, 41% say finances are worse today than a year earlier. That's pretty significant. And that's the second highest reading since 2008. And 28% of Canadians believe finances are going to worsen this year. They're more accurate than the chief economists, some of these places. So the CPI, the Canadian price index, sorry, the consumer price index for April 2022, you can see that this is going up. Inflation rate is at, it was 6.8 recently 6.8, previously 6.7. This is the CPI, it's on its way up. So as you can see, we're not out of this and we're not expecting to get out of it. And this is certainly not transitory, and it's certainly not a low number, and it's certainly going to go up. Now, I'm going to get to that, what it means for real estate investors in just a moment. I'm just going to cover the US, which also is very similar to what's going on in Canada. So while this is uniquely, these articles are uniquely tailored to the US, I've added the Canadian flag here because this is very much a North American economic phenomenon that's going on. So the Fed dangerously and wrongly ignoring money supply, warns an inflation expert. Finally, somebody talking about money supply, because I feel like I've been the only one talking about it. And now, well, there's very few. So thank you. This is so incredibly important. So the government spending in response to the COVID-19 situation is starting to wane, so that's good. We expect a slowing economy, and it's an important indicator to project future economic activity, which is M2. M2 is money supply. So why are so many getting inflation wrong? And I've really tried to nail this one and talk, unfortunately, about it maybe too much. I love all of my fellow economists out there, but there is something that's really getting missed in the mix out there. And this article really goes into why, and it's based on economics training. So this is quote, most everyone is trained in such a way that they're not aware of what we're even talking about. But guess what? All of you are, and you have it at your fingertips. January 26th Research Lab. You will know more about inflation 20 minutes out of your life, summarized, than most people even understand. And money supply is so important. So the Fed and all central bankers, they look at interest rate. But it's the money supply that makes everything happen, not interest rates. It's the money supply. And so what that means is that, and I've got cool, really busy, kind of ugly infographic that you're gonna just get hammered with in a moment. So what this means is that when money is printed, by the way, inflation is a tax. Stop taxing us by printing more money. So as we print money and circulate it, and the economy is not like super amazing, and it certainly wasn't in 2020 and in 2021, that's where we get into trouble. That's where money is circulating faster, and it doesn't have a place to really be grounded, and that's where inflation occurs. So sure way to solve inflation. This is from this article, which was awesome to hear. So since government response, check this out. Since government response to COVID, M2 money supply was up 40% since February of 2020. So the solution is reduce the growth rate of M2 from 13% right now down to 6%. This is awesome. This is a great way, because there's 3 ways to solve inflation. Interest rates, stop printing money when their economy isn't doing as great as it should. And this is that M2 money supply. And unfortunately, a bit of a recession is required. So stop printing the money. Okay, another one by Stansberry Research, M2 money supply. The slowdown has only just begun. What I want to show with this one is just simply this graph that's showing that M2 money supply. So when it's up and it rises rapidly, the economy does the same. It goes and does that. Excuse me. Sorry, folks. My apologies. So if that supply contracts, growth slows down, and we're seeing that M2 money supply is slowing down. So we're going to see that recession, the growth is going to slow down as well. All right, inflation impact. Yes. Also, January 26th was a humdinger. So supply chain disruptions are not inflation. Printing and circulating money is. International crises mean that we're spending and printing more money. Oh, so we've got more inflation on, this is on the horizon. So excuse me, but we've got all of these little components here. You've got the crisis of the pandemic, the COVID-19 one, printed money, debt. Got the Ukraine and Russia situation, printing money, debt. These equal to inflation. Inflation has interest rates go up. And then we rinse and repeat. What's the next one? I think there's something out there called monkeypox. I mean, okay, I'm not going there right now, but just anyways, rinse and repeat, rinse and repeat. So as you can see, until we get some of this money not being printed under control, we will be having rising inflation and oh, Tammy, oh, you went there. I love it. Thank you. I'm not, okay, so Tammy just wrote in the comments, not monkeypox, moneypox. Well, there we go. I mean, the shoe fits. So we will be seeing likely some more money being printed for that. So again, these are times to invest in. It might feel really uncomfortable and awkward and all of these things, but these are really signs that it's time to push forward and take advantage. You know, Richard started today's call with leveraging Ken, for example, because he's real smart. Leverage what we know of the real estate business and how it typically performs and outperforms in inflation. And it typically is one of the most stable assets during turbulent times. And that's really all there is to it in terms of buying signals. So very briefly in the rental market, the Canada is trending up still 9% year over year. Last month was 6% year over year. So we're still seeing upwards trends. Here's the data. We're on track. We're upwards and in line with leading indicators last year. So everything is exactly as we expected it. Rents are up. The Zumper National Rent Report for the US, year over year up 12.8 for 1 beds, 2 beds are up 3.9%. So again, also on the uprising trajectory. These are lagging indicators, and we've had leading indicators pushing those for the last little while. So they're right on track, exactly as one would expect. So these are the types of data that we look at. Oh, look at that, right on cue. Well, exactly. So rents will stabilize though, as we prepare for slight market softening. So you're going to see this. I wanted to show this graph because you'll see like, okay, it's been going up, and then it's like, oh, it's a slight down. You are going to see headlines like heads up. They'll be like, oh, rents are falling. Don't freak out. This is today's message. Do not freak out. Of course, we are going to see rents softening and we're going to see property prices softening. But guess what? That doesn't mean that they're not going to go up, or they're not going to go up a little bit, or at least stay stable until they go up again in the next year and a half. Like there is nothing crashing here because there are dozens and dozens and dozens of other indicators that come in and supporting the story here. This is not about headlines. This is about being really, really intelligent and on focus. So what it means, again, rents are lagging indicators. I think I went through all of that. Do expect them to stabilize for 2023 to 2024. And then they're going to rise for the foreseeable future. So be sure to look though at the data in your market. Each market, like this is, I'm in macro. Remember, we got to get into city specific and right into like neighborhood specific, but the current rent data is a hold. Now you might be going, well, why wouldn't it be a buy? Well, because rent and property market data are lagging. They're lagging indicators. So I wouldn't ever typically use those as a sign to buy something, because that's not what we want to be looking at. That's like an afterthought. That's good. We've already planned for that though, because we're looking at leading indicators. All right, so moving on, property market. Okay, this is, I think, the last section of the macro section, and then we're gonna go through super fast market city-specific market analysis in just a moment. So property market. In Canada, Bloomberg, rate hikes hit Canada housing with first price drop in 2 years. Sales plunge, 12.6% as borrowing costs rise sharply. Okay, there's like so much wrong with this. Sales plunged 12.6% after they've just gone like year after year upwards of like 30, 40%. They're still growing, by the way. And because they're saying as borrowing costs rise sharply, is that the only reason? Do you really think that that's the only reason? Interest rates? No, there are so many. When I look at analyzing actual markets, I look at over 100 indicators. Like the real estate cycle formula is just about like 25 or so, 24, 23 to 25, somewhere in there. And then when we're actually assessing it, we look at like literally 100. So no, it's not because of interest rates. That's just one component of it. So we want to have that whole story, and that's why I'm here for you. So what it means, rest assured that the supply issues and other indicators in many of Canadian markets will keep the prices up, despite the dampening effect on rate hikes. So yes, rate hikes are gonna put a little dampener, but there are so much other stuff going on out there that real estate prices are going to continue to rise for the foreseeable future. Zillow in the US, sales and forecast, look at this, 14.9% growth through March, down from a year ahead forecast of 16.5% growth. Is that okay? Are you guys okay with a return on investment of appreciation of 14.9%? So appreciation in real estate, by the way, the math actually works out even in a market that's, so like when I do my like baseline analysis, I'll use a target inflation rate of like 2 to 4%. So let's say 3%. I actually usually do it at 2%. And real estate still usually, like it wins at a 2% inflation. So, or appreciation, whatever you want to call it, because they typically run in tandem. And so 14.9, that's great. That's absolutely great for home value. So what it means, downward revisions on housing, no problem. We expect downward revisions on the house price values, but they're still going up. So long story short, be wary of the headlines saying major real estate values are going in a slowdown. There's going to be some seriously sensational shit. Yep, really sensational shit going on here. So beware, be wary, it's going to happen. I will say that one more time in case anybody wants to cut that out without the S-bomb. So we do need to be wary of the headlines saying that there are real sensational news headlines coming up, and we are not going to have that as a huge problem. We are going to be in line with inflation, and that will be our appreciation. So that's very good news. What it means is that the current data for the property values are buy and hold signals. So these are very, very positive. Thanks, guys. I know you appreciate it when I swear. So thanks. Love you guys. I can take a quick little breather. Moran, if you want to just pop in for a moment.
Hey, everybody. It's so great to see all of you. And, you know, Jennifer, as you were speaking, a couple of things I was thinking about. One is you made a really, really good point that the economy alone is not the only indicator for real estate. And I think that's really, really crucial to understand. One of the things that I've noticed, you know, even today, we closed on a 12-unit building today. Yes. I'm buying properties. But what I've noticed in my conversations with people is that people are scared because they watch the news, they listen to the headlines, and what happens is that there's one little piece of data, and that gets extrapolated into a massive statement of belief, and is absolutely irresponsible and reprehensible. It's poor leadership from people to make that kind of leaps in logic. If you are in this room, and Jennifer, I'm so appreciative of the information and intelligence that you bring to us, because it helps me buy properties. You know, when we look at inflation, let's stay with me here for a minute. I want to give Jennifer a moment to recoup her voice, but stay with me here for a minute. Let's say you and I this summer, we are going to go on a camping trip. So Paige, Steve, Drew, Denise, Vincent, we are on a camping trip. These are the people I can see on my screen right now. We are going camping. And
I see Dwayne in Mexico. Maybe we'll head down there for a camping trip.
Right.
Dwayne,
hey, now we go. Got it. And guess what? We decide to have a bonfire night. We put up a fire. We built, you know, a big fire. but we got to start this thing and we don't have kindling. So we look around and go, how much money we got? Well, we know Steve Druth is a man of wealth. So we shake his pockets out. We get $100,000. And out of this $100,000, Jennifer, I'm going to assume that I think it's higher than this, correct me, but I'm going to assume a 10% inflation rate right now, real inflation.
Sure.
That means that out of Steve's $100,000, we take $10,000 out. And it's American because he's American. So it's even, it's does $10,000 like 40,000 Canadian. So we take that $10,000, we put it in the fire and we set it on fire to have our bonfire. That's what inflation does to our money. And when there is fear in the market, when there's fear in the culture, you know what we do? We hang tight. We hold our capital instead of putting it into a vehicle that is going to protect our assets. In the middle of a storm, you know what's more important than swimming in the ocean? It's having a really good boat that's going to stay afloat in the storm. And that's what real estate does. If you are what I think you're going to find is that yourselves, myself, because we hear so much out there, we've got to slow down and see what is really happening and trust our analysis, because we become the examples for other people. So, well done, Jennifer.
Very well said. Yeah. Thank you, Naran.
You're welcome.
Awesome. Do you want to go through a couple of little slides? Where can you buy a houseboat? Yeah, exactly.
I can tell you how to buy a houseboat right now.
Yeah.
Okay.
So, Naran, do you want to just maybe go through a couple of these slides and with regard to where we are with the Real Estate Wealth Lab? I think there's only like 3 or 4.
Sure.
The new launch.
Change the slides and we'll get along just fine.
Okay.
If you are joining us and you're not a member, I would really urge you to become a member. Not because, well, let me put it this way. The reason I want you to be a member is because I don't like leaving people behind. There is an opportunity right now in the market for you to grow, to protect your own nest egg, to grow your wealth, and most importantly, help other people along the way. So I'd invite you to join Real Estate Wealth Lab, and there's 3 different levels. We really wanted to make it accessible for all. There's the beginner level. If you don't know where to start, this is where you start. There's an experienced level, and then there's the next level where you have access to deals and strategies and scaling. You get to pick and choose where you want to enter the conversation. Why don't you go to the next slide there, Jennifer? See what we got here. Do you want to?
Can you hear that? Yeah? Okay, great. Thanks. Sorry, guys. Love that music. Oh, you're on mute, Naran.
Sorry. If you are wondering what our next events are, just take your camera, hold it up to the QR code on the top left of your screen, and it'll take you to our live events page, or you can take a picture of this screen as well. And you can always reach us at info@Real Estate Wealth Lab, and we'll be glad to get back to you and serve you in any way that we can.
Awesome. Thank you so much, Naran. And I really appreciate that. And ladies and gentlemen, I'm going to get right on into our market analysis summary. Again, I do want to just say, acknowledge and thank you for your patience with my voice today. I haven't had a cold in a long time. It's been almost a decade. So, hey, you know what? That's not too bad. I'm pretty healthy usually. So thank you again. Apologize.
Jennifer, before you start, I just
yes.
want to just highlight one thing. in the chat, there is a link. So if you're wondering about where to access what I just spoke about, there is a link in the chat. Just click on it. It'll take you to the right page. Thank you.
Oh yeah, perfect. Awesome. Thank you so much. Okay, buckle up, my friends, buckle up. Okay, market analysis summary. Here's a quick little video.
Hello, everyone. This is Jennifer Hunt, the Chief Intelligence Officer with the Real Estate Wealth Lab. We are just getting started and we're already covering markets across Canada and the US. Wow, we were so excited to share this with you. We've covered Toronto, Calgary, Vancouver, Honolulu, Maui, the island, Miami, Fort Lauderdale, Orlando, Kitchener, Waterloo, Cambridge, Ottawa, Phoenix, Houston, and Dallas. And there's plenty more coming. So you'll definitely want to stick around. We've got market analysis that covers everything from leading economic indicators and other politics and policies, right through to what's going on in the rental market and the real estate markets, so that you can know exactly where each city is in its real estate cycle. Meaning, do you buy, do you sell, do you hold? And then what do you do even in those markets at that time? You definitely want to keep track of your real estate markets with the Real Estate Wealth Lab.
Ladies and gentlemen, thank you. As members of the Real Estate Wealth Lab, you are completely responsible for all of this market analysis. Yes, you. Without you, we wouldn't do it. So, thank you.
Hello, everyone. Hello.
So here's a couple, as I mentioned in that video, of what we've already done. But we have so many more to do. And the more of you members that come on board, the more real estate research we can do for you. So again, we always ground it in our real estate cycle formula, looking at 23 weighted indicators. Unlike anywhere else, there's nothing that weights them like we do. Sorry, one moment. All right, so there's nothing out there like this. And we put it in this real estate cycle in terms of a contraction, stabilization, expansion, and note that little you are here. We've got you. We can tell you exactly where and then what to do. Not only buy, sell, hold, but also, thank you, marketing team. I just had you make up and avoid. There are definitely markets that we're going. And if you were on at our last research lab, you'd know there were definite avoids. So that's okay. We've got those covered too. And Allie, I love that you asked about Edmonton, because that will be at one of our next, at our next research lab in June. So come on out for Edmonton. We'll be doing that one. And I'm not sure which one else. Maybe pop it in the chat. What else do you want? What other market for our next research lab market analysis? Whatever you want, anywhere. New Brunswick, okay, Muskoka, Tampa, Hamilton. I love it. Pop it in there. We'll put it in for a vote afterwards. That sounds awesome. So the other thing is we are doing, yes, Canada, yes, the US, but we're also, I think it was recently, one of our recent research labs, we actually started looking at different countries. And I gave you a couple of hints of the top markets in Europe, top markets in Central and South America, top markets in Asia, but the list goes on. As long as there are a relatively reasonable democratic government in place, our methodologies can work anywhere. And this is an incredible time. And I'm not sure, Carol Ann, if you're here today, but if you are, this is for you and many of you out there who are looking to diversify your portfolio. Now is the time. And looking at another country is incredibly important. Yes, Allison, definitely, you too. Because you want to look at different legal protections. You want to look at shielding yourself from different kinds of unscrupulous kind of circumstances, potentially. You want to be looking at different political climates, different currencies, different climate. Think about, you might have a hurricane on one end, you might have a dust storm, or what happened to you guys, Denise and Stuart, in Ottawa? Was that, so it was like a cyclone, non-cyclone hurricane sitch? It like what? Anyway, so that having different locations is very, very helpful. And you want to really look even if it's not for you. At the Real Estate Wealth Lab, we're going to make sure that you're empowered to look at it and to know what options are available to you so that you can be investing in Canada, the US, or wherever your heart desires. And if that's just because you like palm trees and different spots too, that's okay. I know a lot of you do. So that's just fine. So look at, Richard mentioned this at the very beginning in terms of some of our market analysis, and we've just gotten started with sort of these longer reports, and we also have short infographic PDFs that you can actually share with your potential joint venture partners, your clients, whatever have you, and we've got them all in one spot, so it's just a super, super easy. Here you go. And yes, these include buy, sell, hold signs on them so that you know exactly what to do. And then we summarize all of this, by the way. So we're doing all of those markets, but then look, this is what the actual sort of our newsletter looks like on a weekly basis. You'll see there's Canada, and then there's US, but then there's also various provinces and states here as well. And as we expand and more of you come on board as well, we can expand what those look like. And we get right down into city specifics so that you're getting weekly updates on either the state or city that's important to you, so you can be empowered to understand if something has changed. So this is really, really powerful, and I'm very excited for you folks to be able to get that. So our very first one, market analysis Toronto. So as I mentioned, I'm going to go through this really fast. This is just a summary. Now, what we do when we typically do a full, complete market analysis is we do exactly what I did at that macro section for Canada and the US of GDP, jobs, population, and then rental market and property market stats. So all of those those are the key kind of categories, if you will, and then some of the politics as well. So what you're going to get right now is just like really fast samples. So in, for example, for Toronto, we did a GDP, and what was going on is that Toronto was definitely on its way up, but it was less than Ontario, and it was less than Canada. So that wasn't ideal at that time. But because we're not looking, and Moran brought this up earlier, just a few moments ago, we're not always looking at just the economy, because that's only a part of the key. You know what I mean? There's lots of other components. And overall, what we found was, look at this population for the GTA was expected to increase like 49.8%. It did this massive historical dip. and now a massive projected upwards. And of course, it's one of the top areas for immigrants, and immigration is expected to reopen up this year. So we're expecting a major, major influx. And the conclusion is a major buy signal for Toronto. Calgary, this similarly, Calgary had just in terms of the gap, these are historical, by the way. We did these in September. These are changing all the time. That's why you're going to want to pay attention to us always. And these numbers, these particular stats, while they're older, it's okay because we've got the new ones going on, but you're getting a sense of how we're making decisions, what kind of information we're showing you, and what those signals are. And don't worry, if something's changed in terms of like, if Toronto were not a buy, don't worry, I would tell you that right now. Toronto's still a buy. Calgary also, we're seeing, like, look at this population. Okay, so that, again, GDP, it was okay. And it's improving. Oh my gosh, amazing. It's really, really improved. Latest data is exceptional. And look at this population growth rate by comparison to the rest of Alberta and Canada. It's a net winner. Population where people go, people need places to live, and they make money, they make jobs. So again, this is a buy. Calgary is a buy. Vancouver, look at this, Metro Vancouver jobs. I mean, just stable, absolutely stable. Nothing like outrageous, but stable, stable, stable. When it comes to their home prices, again, we are seeing, and now a little bit of that has shifted, but don't get caught up in the headlines right now because they're trying to freak us all out. Like, again, don't freak out because it's just nothing is falling off of a cliff. There is definitely just a little softening. And by softening, again, I want to reiterate it. And Moran said this really well one time. It's like, what it means is it's not that it's going to fall down. It's not going to be less than. It just means that it's not going to grow as fast as it has been. So relax, take a deep breath, and know that we are on a long, long expansionary period upwards with just, again, the softening for 2023 and 2024. Oh, that was a buy signal. Oh yeah, there it is. Okay, so Kelowna, we've done Kelowna. Kelowna, look at that population growth, way more than BC, way more than Canada. This is important. Has anyone been to Kelowna lately? Anyone? Pop it in the chat. No? No? Okay. Well, I can tell you, it's remarkable. I've been watching that market really, really closely. My brother's about to buy, so I'm helping him with his property. It's really exciting. Anyway, it's on fire, that's for sure, and we're expecting it. And so they have the lowest unemployment rates in Canada, and their economy is incredibly diverse and doing exceptionally well. So we have a really, really hot market for Kelowna and a great projection. This is definitely a buy and hold. It's an absolute good location for the long run. When it comes to Honolulu, see, look at this. We've got Canada and the US. There are very, very few that dive into these kinds of layers of depth and breadth that we have at the Real Estate Wealth Lab. So Honolulu, market analysis. Okay, look at this. This is the percentage of tourism. Who cares? Because Hawaii, well, Honolulu in particular, their economy is largely driven by tourism. There's some opportunities for some diversification. And until then, this is very, very important news. And they have now actually, what's really incredible about Honolulu in particular, Oahu, the island, is that they have now hit their tourist numbers that they had pre-pandemic on a daily basis. So that's cool. But guess what's not included in that? International tourists. Japan's not back. New Zealand's not back. Australia's not back. Those are their three primary origin tourist origins. So Canada and the US have taken over in terms of tourism. So wait just a minute until that actually opens up, and this is going to go crazy. This is an absolute buy and buy now signal for Hawaii. Tourism makes up 21% of Hawaii's economy. It's recovering. I think I mentioned that. And this tourism mix, it's absolutely wild. The population, this is why Honolulu I know there's people who are Maui lovers, you're Maui lovers, I understand it, but Honolulu is growing faster than Maui. And even though that's a surprise to a lot of economists, because urban centers and places where people can get jobs, et cetera, that's where, and still there's beach, sand, and palm trees. Exactly. Oh, yes, Dawn. And 6 million Canadians can't even fly due to the mandate. So just wait till that is free. Thank you, Brian Peckford, Honorable Brian Peckford. There you go. Okay. Mark, what kind of rental you think is the best strategy in Honolulu? Oh, Mark. Oh, I know all about that. That's one of my primary markets that I've been investing in since 2010. If you are looking to buy in Honolulu, there are things that you need to know, and in Maui too. There's a lot to know, and feel free, we can just reach out, set up a strategy call so that you can know, or I could do like a special on Honolulu at some point, because you do need to know zoning. And trust me, I know zoning, and I'm on the Oahu Short-Term Rental Alliance. I'm got it in with the governors. I'm learning because the governor is about to get elected. So I'm right in there. You want to know what's going on. So I gotcha. Thanks, Mark. And we can set something up. So same with Maui. If you're developing in Maui, there's even more layers of taxes, by the way, on Maui than there is in Oahu. So that's just something to keep in mind for developing. But still, like, pretty good. Their jobs hasn't been that great in terms of unemployment. It's been pretty challenging for Maui. Their Honolulu has overtaken their growth. But this is what you need to know about Maui. Listen, if you love Maui and you want to do it for lifestyle reasons, then do it for lifestyle reasons. Not all real estate has to be that thing that's a massive return on investment. That's okay. When it comes to Honolulu, Waikiki, it is the most popular, it's the most populated, and therefore there's less risk. There's also some opportunity right now when it comes to all US real estate in terms of foreign exchange rates, good timing. And also when it comes to Hawaii, that floodgate of tourism, it hasn't even opened up. So surf is gonna be up, people, for sure. So I do recommend having an expert on the ground, or at least one to chat with, Allison and Mark. So there you go, and anybody else too. So Miami, Florida. Whoa, I don't even know where to start except Florida. Wow, great migration, mass resignation, great reshuffle, the affordability, and what I have called the place of refuge. It has now become, because of its politics, because of its openness, and because of its governor basically saying it will not be shutting anything down ever again with regard to any COVID-19 government restrictions. And as a result, it's a refuge. And so people are moving there even without jobs. People are moving there even without an economic litter, and they're creating job opportunities. And that's why we're looking at our indicators as we're looking at, okay, you know what, we got to have this as, we want to make sure that we're looking at population independent of GDP, because it doesn't go in that order and how much it weights. And population in this case is pretty incredible. For Miami, this was back in December. Their net real GDP growth was not bad, 2.7. Again, that's net. So the real GDP was 5.4. We like to look at net because that's the real actual up. That's good. So it's really actually moving in the right direction. And it's even better than that now. Rents are ridiculously, they're going up incredibly. That was back in December. They're now upwards of 30 some odd plus for year over year. Fort Lauderdale, same thing. Oh, by the way, these are all buy signals. Fort Lauderdale. Okay, it's similar to Miami. It's like right next to it. So in terms of data, it's sometimes a little bit hard, but don't worry. When we actually do our actual market analysis, not just this summary that's kind of like super quick, we have what we call, what I call proxy data. And statisticians and economists are very familiar with using proxy data, where we make up sort of different questions that once answered gets us very close to what particular metric we're looking for. And so very similarly, Fort Lauderdale was also not bad too, pretty good. When it comes to the median housing prices, way up there, just like in Miami, up 23.75%. Now, what I was showing was rents over there for Miami, but like rents are up, property values. I'm just giving you little snippets of various markets. Orlando, holy cow. So their GDP, it was so-so. It didn't really get where it needed to, but that's significantly changed. And one of the reasons that we don't care is because their population blew the H up. Population went through the roof, 1.19%, huge growth. They're just attracting and attracting and attracting people. And of course, where people go, they need a place to live. So generally speaking, when it comes to Florida and conclusions there, macro indicators, politics and policies. I mean, there's huge influencers because the government is the governor. So the state government is very open. They're not going to be closing down. They're all about business. They're all about supporting. They're all about freedom. So some of the other indicators is that there's just huge opportunity for real estate investing, and you want to watch for outpacing and leading growth. So this is all a buy signal. Now we went back to Canada, Kitchener, Waterloo, Cambridge. I know all you folks out there. Right on. All right, so this is a great example here. I mentioned that proxy. So these are kinds of questions that we would look at if we didn't have GDP. This is GDP data for KWC. So answering these questions, pardon me, feel free to take a picture of them. You can answer them too. If you answer these, they're correlated to actual GDP. And if they're going up, then chances are your GDP is going up. It's very simple. And when it came to KWC, yes, the answer is yes. Huge innovation. It's also the 5th largest CMA in Ontario, which is size matters. Size matters when it comes to real estate and real estate markets, 100%. So those are things that we do take into consideration. Size and growth opportunities as well. So when we looked at it, it's like, okay, we're sort of just at that coming into an expansionary phase. We're not even all the way in there for KWC. So we marked where we are as just at the end of stabilization. And these are some of the do's and don'ts when you're at the end of stabilization. You can do all of these: buy and hold, rent to own, fix and flip, agreement for sale to buy, option to purchase, vendor take back. You want to be cautioned to do a rent to own. Totally doable. It is doable, but just be cautioned on it because it might be more challenging to get that extra little lift that you need out of it. It's not the greatest idea to do an agreement for sale to sell it because the market will be going up a little bit further. Ottawa, we did that as well. And look at that huge population growth in Ottawa, 1.78 compared to 1.18 for the rest of Ontario. These are good. Stabilization period, a little bit further back in stabilization, meaning that there's more expansion to come in Ottawa. What? Denise, Stuart, are you kidding me? Yes, it ain't over. This is a long run, like a decade. Yes, we're going to have such a great party in like 2032. Let's do it. Yeah, the decade party. I love it. So in middle of stabilization, very similar towards the end of stabilization, but there's a couple things that you do and a couple things that you don't do. Rent to owns are not in the picture at this juncture. Just not. You can do anything at any time. You just want to be mindful of where you place your energy and do it right. Phoenix. And Nick, I'm glad that you're happy with that prognosis for Ottawa as well. I know that's where you like to invest and live. So Phoenix, awesome. Wow. So a lot of Phoenix, man, Arizona, in particular, like as a state, and then Phoenix, oh my gosh, like just incredible growth from an economic standpoint, from a net migration standpoint, from a jobs perspective. There's a lot going on there. It's highly attractive. By the way, here's a little tip. If you didn't see this already, here's the top, not in order, but some of the top cities in Metro Phoenix to check out. So I was really grateful. I went and took myself on a tour of Phoenix, I think last year, and I went to Chandler, I went to Mesa, I went to Tempe, I went to Gilbert, I went to Scottsdale, I went and visited all of these locations because I was looking at, guess what? Buying real estate there. So I haven't done it yet because I've been focusing on Hawaii, but these are some fantastic cities. So buy signals, generally speaking. Houston, we've just got one or two more here. Texas, we got into that. 9th largest economy. Look at this. Texas enters 2021 as world's 9th largest economy by GDP. This is Texas. This is a state. One of the 9th biggest world economies. This is huge. Awesome. Okay, so what we're seeing there is huge growth. That's awesome. We're okay with that. Everything, it's full recovery already. The conclusions for Houston is the population is growing. It's attractive, it's affordable. There's lower home prices, lower taxes, cheaper land, growing diverse economy, jobs, industrial and office space, you name it. This is definitely an absolute buy for the years ahead. So that's a buy signal for Houston. And for Dallas, this is our last one at the moment, is that also similarly huge growth, nominal impact based on the pandemic restrictions. So that's fantastic. And similarly to Houston, there's a lot going on there in terms of lower prices, lower taxes, cheaper land, and all this growth. So again, we want to really point out that between Houston and Dallas, those are really good markets to buy in. So ladies and gentlemen, in conclusion today, there you go. But this is what it means. If I was you, I would diversify my portfolio 100%. This is where we are in these crazy times, in these amazing opportunity times. And, you know, I know many of you, and I'm looking at you over there, some of you in Mexico, some of you wanting the Caribbean, some of you are already in the Caribbean, et cetera, et cetera. And
Wow, I absolutely love that video. Good evening, everybody. Richard Dolan here, Chief Growth Officer, sitting here on behalf of the Real Estate Wealth Lab team. So great